Hi, I'm Patu from freefincal, and in this video, let's discuss why I love low volatility stock investing so much. I found that the NSE had launched a new index called the Nifty 100 Alpha 30. I use this as an excuse rather to compare different types of factor-based investing. That is, in a factor index, what you do is you create an index based on a particular type of investing style. So you can look for alpha in a stock, you can look for value in a stock, you can look for quality in a stock, or you can look for momentum or low volatility. So what I'm going to do here is to compare different types of factor investing and show you why low volatility investing makes a lot of sense. So in the Nifty 100 before I go to this, in the Nifty 100 Alpha 30, what they do is to take 30 stocks from the Nifty 100 and find out their alpha. Alpha is a measure of excess return above the market and above a risk-free rate after taking into consideration the excess risk of a stock with respect to the market. So it is excess return of the stock with respect to market and the risk-free rate, taking into account the excess risk, if any, of the stock. So higher the alpha, better the risk-adjusted return. That is, for a given level of risk, the reward that the investor gets is justified. That's what a higher alpha means. Higher alpha does not mean higher return. So let us compare the two alpha indices that the NSE has with respect to the base index Nifty 100. The red line is the Nifty 100 Alpha 30, which is the new index launched end of June 2019. The yellow line is the Nifty Alpha 50. This takes 50 stocks from the Nifty from the NSE 300 and sorts them by alpha, and the stock with the highest alpha gets the highest weightage. In the case of Nifty 100 Alpha 30, there is a combination of market cap and alpha used for determining the weight of the index in the weight of the stock in the index. You can see that both the alpha indices are extremely volatile. The difference between the maximum return and minimum return over every possible 5-year return periods is very huge. So, during a bear market over here, these alpha indices underperform the Nifty 100, but in the bull run they do better. And in terms of risk, you can see that this is the Nifty Alpha 50 has got a slightly higher risk than the Nifty 100 or the Nifty 100 Alpha 30. Over 10 years, the alpha indices have done slightly better than the 5-year window, and they have outperformed the Nifty 100 most of the time. However, there is a higher risk that is associated. Now let us compare the alpha indices Nifty 100 and the Nifty Low Volatility 30 index. So these are 30 stocks with the lowest price volatility. That is, they look at the daily returns and the lowest fluctuation in daily returns. The stocks with the lowest fluctuation, 30 of them are chosen, and the weighting is given as per the volatility. You can see that the gap between the minimum and the maximum return is the lowest in the case of the low volatility index, and that is spectacular. And all the time, over every possible 5-year period, the low volatility 30 index has bet the Nifty 100. And that is the reason why I love low volatility, because you're guaranteed of low volatility, lower risk, because of the way the index is constructed. And it is also able to beat the Nifty 100 consistently. What more do you want? So that is the reason why it is better choice than the alpha strategy itself. And that is what you can see in the rolling standard deviation. The lowest is the low volatility index by construction. And you can see here over 5-year periods, I have added the white line, which is the momentum index. So this this is a BSE index, and it takes stocks with the largest price variation over the past 1 year. And so the stocks which have moved up the most over the past 1 year with the lowest volatility has a higher weight, and that's called momentum. I have talked about this in several videos before. You can have a look at that. You can see that the momentum has done well, and sometimes it is comparable to volatility, but it is outperformed the alpha also most of the time. Of course, the momentum has a potential to outperform the low volatility index, but it does so at a higher risk. You pay a higher risk, then you expect a slightly higher reward, and that's obtained in the case of momentum. You can see that the momentum, the white line is up well above the pink line, which is the low volatility index. That's fine. And again, over 10-year periods, you can see that the low volatility index has comfortably outperformed the Nifty 100 and even the alpha over significant durations. Of course, the momentum has done well and it has outperformed in many of the small durations shown there. That's the white line, but we still need a lot more history to conclude that the momentum index is better. But as of now, you can see that the low volatility is an absolutely brilliant index, and that is the reason why I love it so much. Finally, we look at the value index, which is the green index, the green color. So these are stocks with low PE, low PB, high ROCE. But you can see that the value investing is a pretty frustrating thing for the investor, and you can see that most of the time, especially during a bull run, it does not outperform the Nifty 100, and that can be really frustrating, and I would not recommend it. So in terms of risk also, the value investing index has got a risk comparable to Nifty 100 and the alpha strategy. That is the reason why I love the low volatility index. You get guaranteed lower risk, and so far the return outperformance has been spectacular, and the consistency and the gap between minimum and maximum return also is very low as compared to the other indices. So that is the reason why I love low volatility index. You can look at the full review for more details, and I'll catch you again in another video. If you have any questions,